All right, good afternoon, everybody. Yo, yo. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. All right, so yeah, we got some continuation today. You can see here this upside grind in the market, particularly in the afternoon. Daily candle here, SPY's testing this 380 resistance, which is some resistance from the pivot high in the beginning of October. But we've really kind of broken higher here on the small time frame. We have a pattern of higher highs and higher lows. The intermediate time frame now maybe is beginning to flatten out trend-wise, going from a downtrend to trendless. And our big picture for sure, is still trending down. So we'll see what this turns into. On a percentage basis, the SPYs are up 1.1% or so. Qs slightly less, and the IWM real laggard today from the IWM, only 0.5% in the Russell, which is always concerning when it is acting relatively weak. So that's our SPY daily chart. Q daily chart also looking a little productive. We have a solid close here above this like 275 area. We are above that kind of gap and crap day on October 18th. I think it was Monday last week, or maybe it was Tuesday actually, where we had the inside day. We gapped up real big and sold off all day. The fact that we got above that is solid. So Qs are looking pretty good. And the IWM, really led that bounce here back on October 18th, was the highest, and is a ways away from that high. Whereas SPYs are clearly above that day high, and the Qs are slightly above that day's high. The IWM's not participating in the same way, at least not yet. And it's interesting because these last couple of trading sessions, like Thursday, Friday last week, I think it was Thursday, Friday, definitely Friday for sure. Like we would see some weakness in the beginning of the day that was led by the IWM, and then intraday you would see the IWM begin to strengthen, and that was like the signal that we were going to be able to have like an intraday rally. We definitely saw that on Friday for sure. I think that there was one other session in there where we saw it as well. So that's kind of the big picture. Let's go back, especially because I had some people ask questions about it. Let's go back to the morning meeting today, and let's discuss the big picture game plan that we had for the market and kind of how it worked out. So I guess the first thing that I want to point out here is to go back to Pat's note. So let me pull Pat's note up. I really like paying attention when I'm coming out with my morning game plan. Well, everything in Pat's note, but I do like to pay attention to this short-term tactical sentiment indicator, because it's exactly what it is. Short-term. That's really important. And I've said it 1,000 times before. I'll say it again. Just because this is in the red zone does not mean that you come in and sell all your longs and short the market. The opposite is true in the green zone. For me, I more use this as a gauge of when the market is in the red zone that I don't really want to be doing aggressive buying. When the market's in the green zone, I don't really want to be doing aggressive selling. Just because it's in the red zone today does not mean that the market can't go higher. It can go higher, it does go higher. But what we've seen pretty consistently when the market goes higher, when we start in the red zone and the market goes higher, is that it really struggles to be able to do that off the open. That there's a lot of kind of backing and filling that needs to occur. And I compared it to some other days. So first of all, why did I think that the market could go up at all, even though short-term tacticals in the red zone? What kind of gave me that confidence? It was really just where we're set to open up. So SPYs are gapping above 375. That's an important level. That's after a really strong close on Friday. On the small time frame, we kind of have like a reversal here. We understand also like some of the information that Bill was providing on like 0-day expiration gamma that kind of comes into the market, that the market can kind of be looser in this area. So it's like, to me, we're clearing above resistance. The market can be looser here. I'm looking for a move really to these like upper 380s retest of 390, and I know that there's resistance at 380 also. I feel like, though, certainly the earnings reports tomorrow are going to have a big effect on this. Outside of mega cap earnings disasters, I'm expecting that this market's going to have a little bit more legs to it. The technicals seem to be confirming that to me, at least on a small time frame. So this has kind of made me broadly bullish. But again, going back to that short-term tactical sentiment, I don't want to just come in and be chasing longs like what I just said. When that's in the red zone, it doesn't mean to me sell. It doesn't mean to me short. It just means that I got to be really cautious on my longs. So what I did for you guys this morning was I compared a few other days when we thought that the market could continue higher, but that morning when we were doing our morning game plan, the short-term tactical was in the red zone. And I'm pretty sure that that is accurate for July 20th, July 21st, July 28th, and July 29th. So basically what you had on these occasions is you had 3-day moves. So day one, really big upside day. We close at highs, and that puts the short-term tactical in the red zone. And then the next 2 days in a row, I remember this very specifically, we opened up in the red zone, and it's like, oh, are we going to be able to continue if we're in the red zone? And again, the answer is yes. But both of these days, we spent the first half of the day kind of backing and filling. Like we opened up flat or higher, traded down, eventually found a bottom like 10:30 or so, and then by noon we would break highs. And once we broke highs, that kind of upside grind of systematic buying would really just be coming into the marketplace. We saw that on both of those days. And then we saw a repeat of the same thing again on this day. And I think that the third day, I think July 29th, and if my memory serves me correctly, I'm going entirely based off memory, this might have been bolstered further by the fact that this was like Apple and Amazon reported the night before. But for the most part, it was the same thing, especially on this day, the 28th. We had the really big day one, got that short-term tactical to be, in the red zone. We gap up the next day. Look how big this tail is, though. Like, we closed on highs, so it can be easy to not notice it. But we gapped up pretty big the next day, trade all the way red, trade down a percentage of the previous day, probably pivoted intraday around 10:30, 11. I'm going, again, just purely kind of based on memory. And then by noon or so, we're breaking highs, and that just triggers this upside grind. So the thought process for me today was to look for today to be a day that was very similar to the 20th or the 21st or the 28th or maybe the 29th, but the 29th would have been a little bit different because I think that was the day when we had Apple and Amazon that were really moving the market higher. And it's exactly what happened. The market looks pretty bullish, small time frame. We're gapping up, we're clearing above some levels. We had a great day on Friday, positive Maribozu, good confirming volume, kind of got us out of the doghouse. We're breaking above this little like wedge pattern. The technicals look good for at least some small continuation. I'm not here because I never call bottoms. I'm not here to say that this is the bottom of the year or anything like that, though, if you look at seasonality, there is a chance that this is going to be kind of the bottom for the year. I think that this week of earnings will have a big effect on whether or not that actually plays out or not. But, coming into today, we're looking pretty bullish, but I want to just be kind of cautious on the open. So it was the exact same thing here. We were getting this opening rally, and I just couldn't trust it because of that. But then the added effect on why you couldn't trust this was all of our important confirming factors that we're paying attention to. Look at we got this nice little opening rally that goes from 9:30 to 9:45, holds up even through 9:55 before this negative Maribozu comes in and kind of takes a swipe at it. But look at what VIX's doing at the same time. VIX is going straight up at the same time as the market's going up. So you have a divergence there. I also saw a little bit of a divergence on Friday. I've got the dollar off the open going sideways for the first 15 minutes, and then obviously that broke down a little bit at 9:45 when that manufacturing PPI number came out and it never fully recovered. I also got this TLT, which is one of our important confirming factors, which is just trading lower right away, also just not confirming the opening rally. I think that we stayed up a little bit longer than we would have otherwise. because that PPI number came out. We got that quick bounce here. TLT gave a quick bounce. Dollar gave a quick drop down, and the IWM was relatively weak this entire time, right? Just look at this opening technical price action of the IWM, versus the SPYs versus the Qs, right? SPYs are strongest, IWM is weakest, Qs are somewhere in the middle. And this is another one where how many times have we seen it? SPYs are trying to rally. IWM is not participating. What ends up happening to your SPY rally? Not every time, but a large percentage of the time that SPY rally ends up failing. So we're looking good, but I had no real interest in kind of buying anything. The one thought that I had today that was very wrong was I thought that if the market was not trading well off the open, which is what I was expecting. You could see this IWM pullback, this Q pullback especially. SPYs were actually by far the best. I thought that maybe if the market itself is weak but wants to go up, that some of the growth names could just go without the market. And that was the one thing that was, certainly wrong. But we could tell right away. You could tell right away. Like we were looking for, Teladoc that got, I think, a buy initiation or something as a name that could potentially, squeeze the market higher. We were looking at, Shopify if it could clear above $30. We were looking at Zoom if it could clear above $81. But look at what all these companies did in the first 5-minute bar. And Shopify 5-minute bar is total trash. Even Teladoc that got whatever the analyst initiation this morning. Even this Teladoc, just first 5-minute bar was a total wreck. So any thought process of maybe the growth stocks could squeeze without the market was out the window within 5 minutes. And that kind of left me with nothing to do. XLE was relatively strong, which is great. There's a few XLE names that we discussed in the morning meeting, like Apache, where maybe you could have found yourself with a little bit of an opening trade. But without trusting the market, there just wasn't anything to do. And if anything, the other side of the market worked out pretty well. Pat, perfectly called out that you could go short versus the 945 high in the morning. For myself, I had I think a pretty good call on a Tesla short on this 955 candle before it even closed with this big tail, while it was starting to create the tail versus that high or versus the high of the day. Like there were some good opening little short trades. And then just when the market was looking the worst, if you're specifically paying attention to just the 5-minute, you're looking at the Qs, whatever, here at 1020, that's when I was saying to you guys that I don't think that the market's going to give any downside continuation. I think I literally said at 1020, I don't think this market's going to give any downside continuation. I don't really want to call an intraday reversal in the market because there was no technical signal for that here at 1020. You can see that this bar is just totally closing at lows. But I wouldn't be surprised if we made new highs today. And then, does that new high turn into, some grindy upward movement for the market? And that's exactly what happened. And the thought process was really just an understanding of a repeat of the playbook that we saw on those rally days where we were in a very similar technical situation back in July. And then if we can break highs and we understand that the market can be a little bit looser here, that there could just be some systematic buying that kind of comes in and grinds this market higher and drives this market up into the close. And it's exactly what happened. And then as far as longs go, even though I didn't want to predict a reversal here, there were some really good trades that also got called out to the long side. NVIDIA and AMD, I know that these bear flags were mentioned. And I was like, this is a bearish pattern, but given where the market is and that I don't expect that there's going to be any downside continuation, you could maybe take this, if it breaks to the upside, as a failed bearish pattern. AMD was basically the exact same thing. And the better one was this Meta. Able to see very early here also that this Facebook was kind of creating a bearish pattern here. The 8 EMA had just caught up to the base of price action. This is actually usually exactly when you start to get downside continuation on this type of pattern. But this candle here at 1010 was acting so strong. And I'm watching the market at 1010, really not looking that good. You can see these new lows coming in at 1015, 1020. And I'm looking at this Facebook and how it was really applying upside pressure, and out of nowhere is looking so much stronger than the market does at that time. And I called out a long here for the break of 126. That break at 126 was certainly a little bit sloppy with these downside tails. You may have tried it and gotten pushed out. I hope that didn't happen. And then, no surprise here that the relative strength was just kind of leading news, and then, the chatter on a TikTok ban or whatever really helped this Facebook just then take off for anybody who already had stock. And another clue that really had me looking at Facebook and pins more so than Snap was just how Snap was trading, though. Like, all right, the Snap is even, kind of trading this well here. Out of nowhere, Facebook is showing this strength. You got this failed pattern that could come in at 126, that could be a good trade. And I was thinking the same thing for pins, but pins was actually more difficult because I was first looking at it with this bearish pattern, thinking like, wow, Snap is kind of breaking higher here a little bit. This is certainly a bear pennant. Let's recognize it for what it is. But maybe because Snap is trading well, and I don't think that the market's going to be able to give consistent downside continuation, maybe this pins can actually break to the upside and go. And that failed on this first kind of bear pennant, but then it created another bear flag here, and that one actually broke to the upside, but that more corresponded with the news. So I think that the pins was more difficult to capture, but Facebook to the upside there worked well, and then NVIDIA and AMD on the break of these patterns to the upside. But the thought process, and I just want to also make one thing clear: these are not easy trades. These are not easy trades, because think about how many steps there are to that entire thought process, right? To have to think rationally from a bigger picture perspective, because remember, what's more important? If you've got some bigger picture information that you think is telling you higher in the market, and you got some smaller picture information that you think is telling you lower in the market, most of the time the bigger picture information is what wins. So the better counter trend trades, if you want to call them this, are when you're trading like counter trend on a 5-minute chart because you think that you're in the direction of the daily chart, right? So that's like how I'm trying to think about this. But again, the thought process to actually be able to capture like the AMD long or the NVIDIA long, it's like a very multi-step thought process that it makes the trade not easy. You have to really be starting with a big picture understanding of the market, of how that short-term tactical sentiment works, to recognize that we could be, weak here early in the day and kind of pull back. But what that means is, like, all this is doing is correcting the short-term tactical. This price action right here, like, I wish that there was such thing as a chart. Maybe there is. I have no idea. Where you could, like, see the short-term tactical change as the market's changing, because I can just about promise you that when the market was making lows today, that short-term tactical was solidly out of that red zone, and we probably closed back in it again. So if Pat has that, tonight or tomorrow morning when we're doing our research again, and obviously we'll assess tomorrow how we gap up, or how we gap. I shouldn't say gap up. How we gap. It's going to probably be very likely that we're in a similar situation tomorrow morning as we were this morning, especially if we're looking at a gap up where it's like, oh, these market technicals in the daily are looking good, but do I really want to chase a day 3 off the open when short-term tactical is in the red zone? But that doesn't mean that we can't have this type of price action in the beginning of the day that satisfies that. It gets it out of the red zone. Market can't give any downside continuation because the daily technicals are looking so much better. And then we kind of, round up. And the way that you can take advantage of that is that the market is going to be giving these bearish patterns. And for traders who can't have the same degree of, like, and don't get me wrong, I'm wrong all the time also. I don't want to make this sound like I'm a genius. But there's a lot of traders out there who are looking at AMD as a short right here because of the pattern. And I totally get it. But those traders aren't thinking about all of the other information that we're processing on why there's a very real situation where this pattern breaks to the upside and the stock actually makes new highs as the market makes new highs. So, it made for, like, the game plan from the morning meeting could not have been more accurate. I mean, we literally, like, predicted every single step of the market today and how it worked out. The only thing that was inaccurate, again, was the thought process that maybe we could see some sort of, relative strength, opening squeeze type price action in the growth type stocks. But again, your price action confirms that, right? So it's like if we're looking in for shop at $30 for a break off the open, maybe this is going to be strong and go independently to the market. Pay attention to $30, and $30 never triggers. And not only does $30 never trigger, but this is what your first bar looks like. You know that the trade's just not there, so you're not going to lose. You know, it just you did the research, it never triggered. That's fine. You're going to lose nothing in it because you never get involved in it. You know, same thing with Teledoc. Like, I don't go to Teledoc every day, but it was in play today, and we know it's got a large short float. We've seen in the past that this thing squeezes, but if it got I don't remember exactly what the analyst call was, but if it was a buy initiation, this thing should not be going from green to red in the first 5 minutes of the day with this type of candle. It just tells you that this is probably not, that idea is not going to be working out. So again, a good day today because you had opportunities to put the shorts on that we called out, whether it was the market or it was the Tesla call out that I had, and then at the same time kind of pick the bottom and recognize some of these stocks breaking to the upside as long trades that you could get involved in. And some of them closed well. Like if anybody took that AMD trade with where this thing closed today, up at 59 and 58 and change, almost $59. Like this is still giving you the setup for the $60. Like I'm not in AMD. I've got a little NVIDIA, but NVIDIA is really at my target already, so I don't have too much more. But like if you're in from like 57 and change here, and you've got this dollar plus profit cushion, and that this AMD is really starting to apply some upside pressure on $60, I love the idea of keeping that stock long tonight, seeing if that triggers the break of $60. If we break above $60, especially on a closing basis, you got your 21 EMA at 62.50. That's a reasonable target. You got the negation of this negative Maribozu at $64. That's a reasonable target. With some market cooperation, a bear market rally, we should call that for now until the market can prove itself otherwise. A bear market rally could even bring you back to $70. And in a lower probability, ultimate best case scenario where seasonality starts to come in play, and this market did just, which again I'm not predicting, but there is certainly a probability where seasonality comes into play and the market did put in its low of the year and earnings reports continue to come out good and semiconductors have good earnings reports, you could be looking at even significantly more upside above $70. And again, those situations, even a move to $70, what I keep trying to get across to you guys about reward maximization is that is low probability. It is low probability, but it's always going to be one step at a time. It starts with the fact that you took the intraday trade, it closes well, you swing it. Next thing you know, that swing is breaking $60, which is a big level. That gets you up to this, $62.50 to $64 area. It makes a pivot high there. It pulls back, gives a higher low somewhere. Companies are reporting good earnings. That higher low leads to a move to 70. The market now is following through to the upside, and you get another higher low somewhere, and then you're working your way up to $80. You don't need to have that happen very often to get just incredibly outstanding reward for your risk. If you're buying AMD at $57 today with 35 cents risk versus lows. Not predicting. I'm just saying that there is a probability that kind of situation happens where one level breaks the next, and then you still have stock for the really big move. And again, like I always do like to say, even if they're lower probability, capturing big moves, especially if you can do it with decent tier size, is the recipe to really be able to make a lot of money. So I think that's all I've got for you guys today, and I am happy to take a look at any questions or feedback or anything that you guys have for me. It was a good one. From Mike Reed, maybe later you can quickly explain how the dollar factors into your layers of probability. Sure. So I did do that kind of probability class live last week, and I did not mention the dollar. I did not mention treasuries or interest rates in it because that class I'm really trying to discuss layers of probability that I think are going to potentially be there for any possible trade. There are other layers of probability that are like one-offs. They either are relevant for a period of time or they are relevant for a particular trade. So I think that the market environment that we're in right now just has certain layers of probability that are relevant for just this stage of the market that we find ourselves in, this current market environment, right? And the market environment is constantly changing. So the dollar has been a really important one this year. Interest rates have been a really important one this year, and it's all correlated. You know, the strength in the dollar certainly has to do with the fact that interest rates have been increased as much as they have here in the United States. And it's crazy because everyone, like, you know, you look at inflation, you look at everything that's going on, and you think like, oh my God, America must be doing so bad. And then the reason why like the dollar is so strong is because it's like we're the nicest house in a bad neighborhood kind of deal right now. So in this current market environment, again, a couple things have really been key, and one of them has been the dollar, has been UUP. So what you're going to see this earnings season, I can just about promise you, we saw it last earnings season, is that a lot of companies are going to be reporting their earnings and saying that they took an extra loss or that they didn't, you know, meet expectations for a certain portion of it, or they're taking a write down that's related to currencies. You're going to specifically see that with a lot of these international companies. Like we have Microsoft tomorrow, is that right? I'll bet you my P&L today, and it's you know, it's not a massive P&L for me, but you know, you could do some damage with it if you spent it all night. I'll bet you my P&L. I'll give you odds that Microsoft mentions FX headwinds at some point in their report or at some point in the earnings call. The stronger the dollar is, you know, it just negatively impacts these companies, especially these companies that are international. It negatively impacts their earnings. So what we're seeing this year more and more, you see it all the time intraday, is when the dollar is really moving up, the market struggles to be able to move higher, or the market just sells off. So paying attention to that dollar strength is really important. A weaker dollar will make the market go up, which is one of those things, you know, that I found really interesting with the previous administration. Again, not talking about political opinion, just kind of talking about facts of what happened. You know, at one point, the previous administration, I remember they, you know, were touting, let's bring back a strong dollar. And some of you guys, depending on your age, I remember when I was, you know, younger, that it was king dollar, king dollar. The dollar was always the strongest currency for such a long time. And then, you know, the dollar weakened and the pound really became kind of the strongest currency, and the euro became stronger than the dollar. But I remember the previous administration was like, we're going to bring back the strength of the dollar. I remember, you know, the dollar back in, I guess it was the 90s or whatever, was so strong. We're going to bring back king dollar. And then the dollar started to get stronger, and the stock market was going down. And then all of a sudden they were like, oh no, we don't want the strong dollar. We don't want the strong dollar. So that's kind of just been this correlation. And this pattern here is bullish. This is a bullish pennant in something that's been very, very strong. I kind of feel like there is a higher than usual probability of an ascending triangle failure here on what this pattern looks like. And that's one of the things I was like, we could talk about this in the afternoon meeting if you guys want. You know, first of all, the internals of the pattern. You got 3 negative Maribozus kind of coming in here. So there is some weight to this dollar that's kind of come into play. And I think that if this dollar can really start breaking below $30, UUP, ETF, and earnings reports are not a complete disaster, that's going to be an extra bullish tailwind on this market that brings this market up. And part of the reason I have that thought process, and this is also part of that thesis, though, for the dollar to break down, is for this TLT to take a pause. And the TLT certainly has not taken a pause. If anything, the TLT is accelerating to the downside, but that might not be a bad thing from a technical perspective. The acceleration of this trend to the downside could actually be the beginning of a more capitulatory type bottom that could come in, that could lead to a more significant bounce. And again, the thought process, I mentioned it just real briefly in the morning meeting today, is we're starting to see, and we saw it on Friday specifically, we're starting to see a little bit of chatter come out from the Fed on that they're almost at their neutral rate, that they're almost ready to take a pause on those hikes. Well, if the Fed takes a pause, and maybe we're not quite there yet, but if the Fed begins to take a pause, if that's what they're actually signaling, I don't think that the rest of the world can pause yet. So, we started ahead of everybody else. We'll finish ahead of everybody else. So we pause. You look at those inflation numbers, and again, like the inflation numbers here in the United States, they look so disastrous until you look at them compared to the United Kingdom and the EU and basically the rest of the world. So again, it goes back to us being like the nicest house in a bad neighborhood right now. So I think that if you do see some TLT capitulation, if this TLT is able to catch a bounce because the Fed is indicating that they're gonna slow down on their hikes, and we started to see that with that Wall Street Journal reporter, seems like he keeps getting the scoop almost like directly from the Fed themselves. We saw a little bit at the end of last week, some of the Fed members finally begin to pull back on just how hawkish their language was. If that happens and the rest of the world is continuing to have to hike, you could seriously see the TLT kind of catch a little bit of a bid here. And then I think that in conjunction with, again, the rest of the world continuing to hike, could weaken this dollar a little bit, and that could lead to a further market move to the upside. Now, the flip side of that could be, so one of the other things that we've discussed, and it's going to be really interesting to see how this happens. So and this all goes back to your question, Mike, and I know you asked about the dollar specifically, but we should also talk a little bit about interest rates. The TLT has been this interesting one over the course of my career where the correlation is very inconsistent. In certain market environments, like right now, where the treasuries are heading lower and interest rates are heading higher, it's very bearish for the market. But there's other environments that I've traded where bonds moving up and interest rates going down has been bearish for the market. And that's probably actually, I don't know which correlation is more often historically. I don't have the data on that. So if I had to take a pure guess, though, my pure guess would be that the correlation is historically more often inverse than what it's been doing now, where they're both selling off at the same time. Because traditionally, in a lot of ways, treasuries are viewed as a safe haven. So, yeah, for sure. So traditionally, treasuries are viewed as a safe haven. So when the market is at its most fearful, when the market is really heavily selling and selling and selling, that's a lot of times in conjunction with treasuries catching a big bid, because everyone is scared, everyone is rushing to get their money out of the market, and they're buying up treasuries or gold or whatever their kind of safety play is. So sometimes you see that correlation flip completely. I don't think that what we have seen as far as this correlation between treasuries and stocks, where they both are going down and down and down continuously, I don't think that I don't think it can last forever. I honestly don't think it can even last for that much longer. The big thing is going to be what outperforms what. Like, do people at a certain point just start going, wow, I can get 4.3% on a 2-year, 4.1% on a 10-year, and everyone just starts buying, selling their equities to buy treasuries, and then you see actually, and I'm wrong about this upside bounce, or maybe I'm right about this upside bounce, but we get another leg lower because people are like, hell, I don't want to deal with the risk that comes from the stock market. Plus, I think that we just saw, I think there was data from one of Pat's notes, or data from Bill maybe, or someone, where we just saw some data that the spread between the S&P dividend and treasury yields is at a historical inflection point. So I think that first of all, just because something happens in the past doesn't mean that you have to inflect there again. But it's just kind of further data on what I'm saying, where I don't think that what we have been seeing for so much of this year of market down, bonds down, trading together, 60-40 portfolio, just like probably the worst year, or definitely top 5 worst years in like modern market history. I kind of view modern market history to basically be like Great Depression forward. I don't think that that's going to be able to continue to last, but is it because the investors just start saying, hey, I don't want to be in the stock market anymore for 4 point whatever percent dividend when I could get that risk free from treasuries, and then treasuries begin to catch a bid? It's going to be interesting to see how this plays out. I don't have all the answers to that. I don't have any of the answers, actually. A lot of this is just thought process and conjecture, and the technicals will definitely tell the story. So for now, what I'm looking for from a technical perspective is, how does this pattern in the dollar break? It's technically a bullish pattern. It could easily break to the upside. I just kind of have this feeling, sort of maybe, with those negative Maraboses in there and kind of that bigger picture thought process, that this could break to the downside, even though it's technically a bullish pattern, and that helps the market. But let the technicals tell us what they want to do. Be more bullish on the market if you see UUP breaking below 30. Be less bullish on the market if you see UUP starting to give a close above like 30.50, 30.60. And then the other thing that I really want to see, just the pattern, how this plays out, is that this TLT is accelerating. The way that the selling is happening in this TLT is accelerating. That can't last. That can't last. But it doesn't mean that we can't get another leg down or further capitulatory move before a bigger bounce happens. I'm not necessarily advocating close your eyes and come in and buy. Though if you got some spare cash, it might not be the worst idea in the world to buy some treasuries for yourself for some safety. Or they've got those inflation covered, I don't know what they're called, that they're yielding like, there's an add-on on inflation. I think it resets quarterly or something like that, and they're yielding like 9 point something percent right now. Yeah, the I bonds, that's right. Tips and I bonds. I think I was specifically referencing the I bonds. There's a limit on how much you can buy, like 5,000 a quarter or something like that, $5,000 something like that. So that's the thought process, Mike. Maybe you got a 10K per year. Thanks, guys. Maybe you got a longer answer than you were looking for, Mike, but it's a really important topic and a really important conversation that you kind of brought up there. From Ron, 10:30 period on the Qs. What made you think that may be a bottom for the day? Yeah, I don't like to call bottoms, but I think I kind of said that it could be a bottom for the day. It's just exactly what I was already explaining with the thought process of what we saw in those previous days in July on the short-term technical sentiment, on how it worked, coupled with the fact that I think the big picture technicals, the daily chart technicals, are starting to look a little bit more bullish, and I expect that to generally be the victor compared to smaller time frame weakness. From Barack, when you are trading the indices, why not do it in futures to take advantage of tax benefits for futures? So I'm in a prop account, so it's just entirely different, and I'm also not an accountant. So I definitely don't want to give accounting advice. That is not my area of expertise at all. But I'm in a professional prop account, which means that I get a K1 at the end of the year for tax purposes. So there could be some differences there with a 1099. I know that there are tax benefits with futures compared to stocks. I don't know the degree to which that applies or doesn't apply to a prop account, or any potential accounting benefits that come from a prop account versus futures versus a retail account. It's a little outside of my area of expertise, but this is the account that I do all of my active trading in, that I can tell you with a certainty, and I don't have futures turned on for trading in any way at T3. Though T3 does have futures trading and equity trading and options on futures, so all that is accessible. But I'm specifically an equity trader. From Ryan, can you explain what you mean when you refer to as Systematic buying. Yeah, sure. So, there are algorithms that are just programmed to buy or sell. And if it's buying, then it's buying. And, there's many, probably thousands or hundreds of thousands of different algorithms that are, in the marketplace at any one point in time that a lot of the big players out there are using. But one of the ways in which we refer to systematic buying, and you can refer to Pat's note on one of the days from last week on this, but so if you get like an MBA, if you get like a master's degree, one thing that they teach you, and I don't have a master's degree, I don't have an MBA, but one of the things that they teach you is that volatility is risk. So, or that risk is volatility, or volatility is risk. I used to do a lot of more like, the process here on joining T3 as a professional trader has evolved over the years. But, I used to do these like interviews with some serious interview questions in all of them if you wanted to join the company. And one of the questions that I would always ask every single person that I was speaking to about potentially becoming a prop trader at T3 is, what does risk mean to you? And almost every time I was speaking to an MBA, they would immediately say volatility. And I disagree with that personally. I view volatility as opportunity. Volatility basically means higher risk, higher reward in a lot of ways. So for me, for the way that I trade, I view that more as volatility than risk. But there are a lot of market participants out there that view volatility as risk. And if you are building out a algorithm to trade the market, there are a lot of algorithms that are out there where one of their major inputs on how much buying they're going to do or how much allocation they're going to have to the long side of the market is where the VIX is how much volatility is actually coming in. So one of the things that we've seen a lot of just data on is that you got all these funds out there that as volatility declines, their long exposure has to increase. Because as volatility declines, their methods are saying that there is less risk in the market and therefore they should have more exposure to it. And what that creates is systematic, meaning, automated, continuous buying that is coming into the market, and that buying is happening through algorithms. And what the specific execution formula behind it is, I don't know. There's probably a lot of variability, but it's just going to be, kind of creating that, like, for years and years and years, we were just talking about the never-ending bid in this marketplace. And that was as the VIX just continued to bleed and bleed and bleed and bleed till, what did we have? Like a VIX at like 12 forever? And that just brought in this seemingly undying bid into the market. And maybe some of that, is the Fed, or was the Fed with their, QE infinity that was going on. And a lot of that was just, the systematic buying that's coming in from funds, or honestly hand in hand of a virtuous cycle of, the Fed continuing to support liquidity in the market, which is lowering volatility, which is causing, those type of algorithms to just continue to buy and buy and buy. And again, Pat's note last week had data in one of the charts that basically kind of just showed where those funds are right now as a percentage of capital invested, and basically there's a lot of data, and this is what we see. This is what we see in it, and it creates feedback cycles in the marketplace. And by the way, one of my major the hell was that? It's just a massive slam just occurred out there. It's kind of crazy. And also made me lose my train of thought. It sounded like somebody just dropped like a bookcase down a flight of steps. We're talking about systematic buying in the marketplace, right? Oh yeah, feedback cycles, themes. So I hope they got that class properly posted for the members of T3 Trading Group to be able to see it. This class that I filmed over a year ago. Cool, yeah. So one of my themes also is that markets work in feedback cycles. Buying leads to more buying, and the market selling leads to more selling. And we've seen that so consistently even this year. That's what a bear market rally is. It's a feedback cycle of buying that comes in the market. And the reason, and they've been super like exacerbated in this particular bear market, because I think that there is so much, so much of the market's become systematized, where whatever gets the market going initially, whether it's a piece of news or a little short squeeze rally or just an improvement in sentiment, or just sentiment gets so bearish, there's no one left to sell, whatever gets us going initially, once we start going, whether it was here in July and August or kind of back in March, that just really begins to feed on itself. Because the higher that we go, the more hedges need to be covered, the more shorts need to be covered. The higher we go, usually the lower the VIX becomes. The lower the VIX becomes, and the rolling off, because they're backwards looking also. As time goes by and like you begin to roll off on the models, like some of the highest volatility points, that then brings in like the systematic bid behind it as well, and then you can just get these feedback cycles of buying that just kind of really continuously last in this market. And that's all what I call kind of market dynamics. So that's one of the big things that I'm also thinking about, right now is of course, I always want to take things one step at a time. I'm a big believer in that. I will. You're never going to hear from me. I think that this was just the bottom for the year. I save those big calls for Josh. Josh likes to make those really big ones sometimes. You're never going to hear from me like, I think this was just the low of the year, or I think that this low right here is going to be like the low that leads to one of these massive bear market rallies. I don't make those calls. I'm very much one step at a time. But the way that I'm always thinking is that every move has the potential to be one of those moves. So that's even what I was just kind of describing to you guys when I was thinking about reward maximization, even off of a trade like this AMD. Most likely, what's more probable? That AMD, comes down a couple dollars here and breaks this low and stops you out on a swing trade if you're long? Or that AMD goes to $80? What's more probable? Absolutely that you get stopped out of the long. But the risk reward is massive, and at a certain point, the feedback cycle can come into play. So you can make huge amounts of money to the long side on these bear market rallies if you've got the stock and you're not afraid to hold it, and you recognize that this feedback cycle could kind of come into play. So I've still got stock from this low here on Thursday, and I'm not going to say that this is on whatever Thursday this was, the CPI day. And I'm not going to say that this is the low for the year. I'm not going to say that. I'm not going to say that this is even when we immediately bounce this next day, that afternoon. I wasn't saying that this could lead to any sort of massive rally. But what I will say is if it does lead to a massive rally, that I'm going to have stock for it and I'm going to get paid on it. So again, it's just kind of one step at a time in these feedback cycles as they come into play. And we want to think about it. We want to understand all these market dynamics as we're thinking about how we can kind of maximize reward from when we get stock in really good spots. And if they stop us out, then they stop us out, and we revisit the next trade and assess the entry and assess the risk and kind of take it from there. So yeah, whatever question set off that rant, that was from Ryan. Hope that helps. 60% of capital gains are taxed as long-term in futures. Single ES contract is equal to 50 SPY. Yeah, the other thing about it is just how much leverage I get from the T3 account that I have to make that. I have to remember that in the math formula too. From Sebastian. Today, do you consider the intraday pattern on Tesla before 12 o'clock to be a head and shoulders? I don't like a head and shoulders pattern on small time frame charts, and I also don't like cup and handles on small time frame charts. But yeah, I can definitely see it. You have to consider the downtrend, where the downtrend is coming from, and you have to use kind of multiple days of price action, I think, to think about it. because remember, a Head and Shoulders is a reversal pattern, but you have to be reversing a trend, so there had to have been a downtrend. But you could make the argument that the gap was it, or even the price action going back to $122 is it from several days ago. So I'm fine with that. And then it comes down, you have your left shoulder, your head, your right shoulder, and then it works its way back up when it breaks the neckline. Sure. Again, I don't love that pattern. I think that the reason why I don't like Head and Shoulders or a cup and handle on like 5-minute charts intraday is because the pattern takes so long to build out that it's usually not very executable. Technically, you'd have to be buying 205 versus the low, and you're looking for $7 worth of upside. So it certainly gave that. It worked perfectly. So is it that? Yeah, it looks like it. Would I trade it? Am I looking for it? Probably not. I bought the break of 205 at 11.55, but managed it as a scalp and made little. Now I check it on a higher time frame, and it looks to me that it was a good zone to buy for a swing. What do you think? Yeah, I mean, that goes back to, though, just always trying to hold some for reward maximization purposes, because it closed well. And you know, this trade back through $200 on the long side ended up actually being a decent trade. I think it failed the first time. I think it made like a low of 199.60, came back through, and then broke that low, and then that new low is what held here, and it broke back up. So you kind of had to really stick with it and be a believer in Tesla, which I am not. But 200 is a solid psychological level, and then it closed well, and the market looks good. So yeah, if you did have it, you could swing it and see what it could do. What's this scary headline that you guys are talking about? Russia tells UN Chief Security Council in letter, we will consider Kiev's use of a dirty bomb to be an act of nuclear terrorism. So they're laying the groundwork for them to turn the table and be able to do the same. Yeah, definitely scary. Definitely scary. From Mike, quick trade review. I shorted the first inside 5 of Meta at the open. Okay. Nice and relatively weak, inside 5 and down. I like it. The only thing I would say, the only thing I don't love about it, the only thing, and I do like it, is that it's a bit extended on the trade. It's still a bit extended because of how big the gap was and how it was having downside momentum. So it's a little bit extended. I noticed it was looking heavy, staying near lows, while the rest of the market was negating its initial 5-minute. Yeah, certainly relatively weak early on. I miscovered my risk by a few cents. That sucks. It sucks. This looks like a big enough. Just eyeballing it, I would have thought that you'd be able to get your risk covered here. But it's really unfortunate. I like the trade, and that's what happens sometimes when you're shorting extension. Like this could have, because it was so extended, this could have shaken you out and still worked, which would have been super frustrating. Obviously, I think what happened, you know, my call out through 126 was because I saw it being relatively strong at this time, but I think it was only relatively strong at that time because of whispers of the potential news on TikTok type of deal, and that kind of changed it. And if that news never actually came, this bear pattern really could have worked out, and you could have gotten shaken out. And again, that's why I hate when I'm using stop losses that the ADMA hasn't confirmed yet. I understand you have to do it sometimes. You're just taking a momentum trade. This is a momentum trade. But I know personally that if I was in this and I got stopped out, where I'm assuming you got stopped out, the break higher than the inside 5, and then I saw this thing making new lows, I would have been losing my mind. So that's why I really struggle using stop losses that haven't been confirmed by the ADMA. But let me read the rest of what you wrote. I noticed it's looking heavy, steering near lows. Okay, I miscovered my risk by a few cents. It stinks. It got stopped out at the 945 pop. Okay, when shorting near opening lows like this, should I maybe try to cover quicker in the future before breaking the low of the day, or keep my game plan? I would keep the game plan. I think you traded it entirely correctly. You just didn't get your one-to-one fill, which is unfortunate. And the only thing again that concerns me, and for me this isn't even a reason to not take the trade. It's just to recognize, you have to at least recognize that you have a higher probability of getting shaken out because the ADMA hadn't caught up to your stop loss. So hope that helps you there, Mike. And it looks like I got through the questions. We got a big week this week, so I'm gonna end it. I would just say, so you guys know, usually when on the day that Apple reports its earnings, I either cancel the afternoon meeting entirely or I do a very short abbreviated meeting for like 10-15 minutes because Apple usually reports at 4:30. I might cancel it this time around entirely just because Apple, Amazon, I think Pins is reporting that day too. So it's like the 1 day per quarter. It's not a Friday that we sometimes don't do an afternoon meeting, or we do an abbreviated afternoon meeting. So just throwing that out there now on Monday, so you guys know for Thursday that there's a good chance we cancel it. All right, everybody, have a great night. Good day today. We called it pretty well, and I'll see you all tomorrow.